Welcome back to Tax Tips in a Minute with Mike and Ryan. I'm Mike.
And I'm Ryan.
Today we're going to talk about some of the individual tax changes from the One Big Beautiful Bill Act that was signed into law on July 4th. The One Big Beautiful Bill contained many important tax changes that are likely to impact significant numbers of individuals and businesses in the current year and future tax years. Today we're going to talk about the individual changes, and the following items are going to represent some of the key provisions impacting individuals in the One Big Beautiful Bill. First, the reduced income tax rates have been made permanent. Those were subject to sunset at the end of this year, but they're now permanent. So the 7 tax brackets at 10, 12, 22, 24, 32, 35, and 37% are all going to continue and made permanent. Those will also be indexed for inflation after 2025. Increased standard deduction. The standard deduction that was passed by the previous tax bill, the TCJA, has been permanently increased and enhanced starting in 2025 and beyond. So for 2025, the standard deduction will be $31,500 for joint filers, $23,625 for head of household, and $15,750 for single filers. The child tax credit has been permanently increased to $2,200 per qualifying child for tax years 2025 and beyond, and that will also be indexed for inflation in future years. Miscellaneous itemized deductions for individual taxpayers have been permanently eliminated. Those were temporarily eliminated under the TCJA, and now they are permanently gone. However, the One Big Beautiful Bill Act did add a new deduction for educators. So K through 12 teachers, counselors, coaches, and aides working at least 900 hours per year are allowed to deduct unreimbursed classroom expenses starting in 2026. A change to the estate and gift tax exclusion amount is that the exclusion has been increased to $15 million, which will be indexed for inflation each year. And that takes effect after December 31st, 2025.
Well, those are some fun changes. I'm excited about those. I hope all the other taxpayers are too. So there's more. And so if you are 65 or older in tax years 2025 through 2028, there's a new $6,000 deduction per qualified person. Keep in mind, there's a phase out if your adjusted gross income exceeds $150,000 if you're married filing jointly, and if it's in excess of $75,000 if you are filing as a single individual. There's also a new car loan interest deduction. This is for individuals. Doesn't matter if you itemize or not, so that's good. You can deduct up to $10,000 per year for interest paid on loans for new personal use vehicles. And this is going to run through 2028. So 2025 through 2028. There's a catch, as always. So the loan has to be for a new U.S. assembled vehicle that is under 14,000 pounds. So I assume the IRS will give us some more guidance on that, and car manufacturers will be sending out all these cool emails and everything else telling you that some sort of car qualifies. So keep your eye out for that. But that's a $10,000 potential deduction. The deduction for qualified residence interest has been capped at $750,000, and that's permanent. There is a new tax deferred investment account for children, and these are called Trump accounts. I'm sure a lot of you might have heard of these already, but essentially a taxpayer can contribute $5,000 in after-tax dollars, that is, to a diversified U.S. equity index fund, and that's per child, so $5,000. And then if you have a child between January 1st, 2025 and December 31st, 2028, the federal government's going to throw in an extra $1,000. So if you can start having kids, hey, that's a wonderful thing.
It's a good time to have some. That'll be interesting to see if the if the parents' contributions to these are excluded from gift tax exclusion or calculations, or if, how does this cross over or interact with an IRA account or a 529 plan? There's a lot to come on that one, I think.
Yeah, I agree. But it could be a potential baby boom. It's $1,000
for
I'll take
$1,000.
it. Yeah. So speaking of 529 plans, there's been some changes to those as well. Let's see. Basically, the 529 plans have been expanded to cover more educational expenses, not just tuition, but now books and online materials, tutoring fees, standardized test fees, a whole litany of items. So that's good. But that in 2026, the annual limit for K-12 distributions doubles from $10,000 to $20,000 per beneficiary. So that's good. In addition, this is in regards to the 529 plans. It can cover not only college costs, but other qualified post-secondary credentialing expenses. So basically, you can use these for fees, book supplies, tuition, whatever, for certificate programs, licensing programs, apprenticeship programs, that sort of stuff. So it's not just what we think of
not
as
just for college,
just not a standard college education. So this might be good if you got somebody in the trades or whatever. There's a big push right now to get people out into the trades and let's start building stuff again. So this is good in that regard. As far as individual charitable contribution deductions, those have been capped. 60% ceiling for gifts to what's referred to as a 50% charity. And then
I think that's actually the same as it was under the TCJA.
Yeah,
but they've made the change permanent now.
It's permanent now, so that's another good deal. And then finally, I'll speak to this and we'll wrap it up. But for casualty loss deductions, those have been limited. So starting in 2026, if you have a personal casualty loss, they're permanent. They are limited only to federally declared disaster areas. Okay, so previously it was more wide open, if you will, but when one of these disasters rolls around, if it's a federally declared disaster area, that's like an official pronouncement from the government, then you can take these personal casualty loss deductions. I know that's a lot. There's a ton of stuff in this bill. So Mike, I'll throw it back over to you to wrap it up.
Yeah, this bill is really very extensive. There's just so much in it. There's going to be a lot of guidance coming out from the IRS, from the Treasury Department in the near future and in the medium term. So navigating all these changes can and will be very complex, and their impact on your specific tax situation will vary by individuals. So please reach out to your Singer-Lewack tax advisor for more information on the changes here in the One Big Beautiful Bill and information on steps that can be implemented to help you take advantage of potential tax planning opportunities now that this One Big Beautiful Bill has been passed into law.